I just bought 20 shares of the Intercontinental Exchange. Not because it owns the New York Stock Exchange. That's a marketing tool that generates less than 5% of its top line. I bought it because out of the public eye sits a triple-layer moat, including a mortgage platform with 99% customer retention. And the stock trades 30% below its closest peers because of a temporary freeze in US housing. To a rational analyst, that's a setup, not a warning. So here's the data behind the compounder nobody's talking about. The New York Stock Exchange on Wall Street is the most famous brand in global finance. The iconic ringing bell and the floor traders shouting over each other. But most people still couldn't tell me who owns it. The answer is Intercontinental Exchange with the ticker ICE. And New York Stock Exchange isn't even the most interesting part of their business. In their full fiscal year of 2025, ICE generated a record $9.9 billion in net revenue, and $5.4 billion came from the exchange segment. This is the largest of their segments and generates 56% of the total revenue. But do you know how much of that came from equities and equity options trading on the New York Stock Exchange? Just $467 million. This is only 4.7% of the entire company's top line. So the most famous stock exchange in the world isn't even the core cash generator for this business. It's just a high-profile premium marketing tool. It's the image that gets people on TV and the reason investors recognize the name Intercontinental Exchange at all, even when they don't actually realize what they do. It gives ICE credibility and a massive brand equity. But the real cash-generating engine is somewhere else. So, if the world's most dominant stock exchange is just a side hustle for ICE, what are you actually buying when you own the stock? You are essentially buying a software as a service and data subscription company. 49% of their revenue is pure, predictable, and recurring revenue from software and data subscription for institutional investors. Their mortgage software processes half of all US loan applications. And when the macroeconomics are under pressure, their energy future transactions spike. So it's a well-balanced financial fortress. And right now, ICE in blue here is trading at a 20 to 30% discount to its closest peers. But to understand why this discount exists, we have to look at their triple-layer moat. ICE operates 3 businesses. On first glance, these look completely unrelated, but they are not. The first is exchanges. They operate 12 exchanges and 6 clearinghouses. This includes energy and agriculture futures alongside the New York Stock Exchange. These futures include Brent crude, natural gas, cotton and coffee. Basically the contracts that global commodity markets price everything against. So if you are a multinational corporation or a sovereign fund and want to price Brent oil, you don't have a choice. 90% of global Brent volume clears right here. And this is also where most people stop when analyzing ICE. But their second segment is fixed income and data services. Here they provide bond pricing, analytics services, and index calculations. So if an institutional portfolio manager needs to value a corporate bond or benchmark a fixed income fund, they use ICE's data and software infrastructure. And this segment makes up around 1/4 of their overall revenue. Their third segment is mortgage technology. ICE owns Encompass, the software platform that processes roughly half of all US home loans. ICE doesn't handle the mortgage loans themselves. They own the origination software, the infrastructure that lenders use to open, process, and close every mortgage application. And this segment makes up 20% of their overall revenue. That's also the segment that most investors miss. And it's also the one that explains the discount of the stock price. Now, moats get thrown around a lot in investing. So let's break down the mechanics behind this specific moat. Because it's not just one moat. I would argue that it's 3 stacked on top of each other, each with different mechanisms. And layer 1 is the exchange network effects. ICE controls roughly 90% of the global crude oil futures volume. CME Group, the largest derivatives exchange in the world, has spent years trying to compete. But they couldn't move the volume, here the daily average energy future volume in orange. And that's the entire point. because exchange markets are winner takes most by design. Liquidity attracts liquidity. Traders go where the tightest spreads are. And market makers follow the traders, which further tightens the spreads. This is a positive feedback loop that compounds until one dominant market survives. And we can actually see this in the pricing power. For example, the average rate per contract. These are basically the fees the company collects per trade. And in the case of ICE, these are $1.74 for energy futures. For CME Group, it's only $1.22. This is roughly 42% lower than ICE's. And in agriculture and metals, the differences are even bigger. Now, CME doesn't report the full year metrics, so I'm comparing the average rate for the year 2025 from ICE against CME's most recent quarter. But in theory, this should even give the advantage to CME and just shows even more how dominant the position of ICE is here. The second MOAT layer is the switching costs on the mortgage platform. Encompass processes roughly half of all US residential mortgage originations. That number gets quoted a lot. What gets quoted less is what it actually means operationally. A lender running Encompass has integrated it into their loan workflow, compliance checks, document management, and market connections, often over years. Ripping it out doesn't just cost money. It means retraining every employee, rebuilding every integration, and absorbing the operational risk of a system migration, while at the same time keeping the regulatory compliance. ICE reports retention rates of 99% for this product. That's the switching cost as a number. The third MOAT layer is fixed income data subscriptions. Over $2 trillion in assets are benchmarked against ICE's fixed income indices. And the institutional portfolio managers use ICE's data straight into their portfolio management software, risk compliance software, and internal valuation modules. And because of this deep integration, they don't switch data providers because of costs. They switch when a competitor offers something meaningful better. But data quality and coverage depth compounds over decades, so the bar is extremely high. The lock-in effects are similar to Encompass. Once the data is embedded in the investing process, it stays. That's also why this segment provides a big portion of recurring revenue, same as the mortgage segment. So we have three segments with three different MOAT types. When you combine the two subscription pillars with the exchange business, you get a highly resilient architecture. Over 51% of ICE's total net revenue in 2025 came from highly predictable software and data subscriptions. But the MOAT argument only means something if the financials back it up. And they do. ICE has compounded their EPS at 13.9% for over 19 years. Through the financial crisis, through COVID. That's not a growth stock trajectory. That's a toll booth with pricing power. And the EPS even understates the cash generation. Because they could grow the free cash flow over the same time by over 20% per year even. The reason is that ICE converts revenue into free cash flow at a 35% margin. That's the structural advantage of a business where the cost of processing another future contract or renewing another data subscription is close to zero, and any growth in the top line revenue hits the bottom line immediately. And that's also the reason why they are constantly reporting record quarters and years. So the MOAT is real, the numbers confirm it. And if you like this kind of rational and data-driven analysis and think that it helps your own investing, hit subscribe. I post up to 2 of these videos every single week. So with ICE, we have a monopoly in energy contracts, a dominant mortgage software ecosystem, and an irreplaceable fixed income data franchise. A company that has compounded its earnings for 19 straight years through every macro crisis imaginable. So you would think that a business like this spits out near perfect results in my stock scoring system. But the master score comes in at 6 points for 5 years and 6.6 for 10 years. For such a monopoly, that looks like a red flag. But when we look at the quality, the underlying business and MOAT gets a perfect 10. But the quality score gets dragged down by the cyclical nature of their sector and their conservative shareholder returns. ICE's ROIC also only sits at 7%, which is low for a business of this quality. The reason is the $13.6 billion of goodwill sitting on the balance sheet from the Black Knight acquisition. That goodwill inflates the balance sheet and suppresses the ROIC. It's an accounting effect, not a business quality problem. But we'll come back to what this actually means in a minute. First, the last number worth flagging in my scoring system is the value and momentum score, which sits at 3.3 and is also dragging the whole score down. The stock is down roughly 21% over the last 12 months and still over 10% in the last 6. The valuation is still not really cheap. But that's not a warning. For a rational analyst, this is a great setup to look for. Because we know that the ROIC score is suppressed by a massive balance sheet item from an acquisition, and the marking is pricing the stock at a discount because the mortgage business has stagnated in the last quarter and everyone seems to think that this segment is permanently broken now. In 2023, the total US mortgage origination volume fell to the lowest level of at least the last 10 years. This also roughly correlates with new mortgage applications, and here we can see that the last time the new purchases were so low was back in the 1990s. And because ICE's mortgage technology segment charges a transactional fee for every closed loan they process, the market looked at this and assumed that this segment was dead. But the reason this collapsed isn't complicated. Because between 2020 and 2021, roughly 40 million American homeowners refinanced their mortgages at rates near historical lows. So when the Fed moved rates in 2022 and 2023, which also increased the mortgage rates, those homeowners stopped moving. Why sell your house and give up a 2.5% mortgage to take on a 6% one? You don't. You stay put. And transactions freeze. But I don't think that this is a permanent shift in how Americans buy homes. And when the rates normalize a bit and the dam breaks, the volume that is currently frozen will hit the market. And at the same time, the infrastructure of ICE is not gone. So when the mortgage market recovers, the revenue generated by this will directly hit the bottom line of the company. The market is pricing a permanent depression into a cyclical trough. And that gives rational and fundamental investors a chance. Now, remember that value and momentum score of 3.3 in my quant trading tool, with the stock down by 21% over the last 12 months? When we compare this to the closest peers, companies with the exact same high margins and asset-light institutional subscription model, they are currently the cheapest of this bunch and are trading at a discount of 20 to 30% below their peers. While MSCI trades at almost 30% forward price to earnings, ICE only trades at 17.7 times. And it's also trading well below their own average valuation of the last 5 years. But to find out if this discount is a mistake or a rational warning sign, let's use my valuation spreadsheet to run a reverse discounted cash flow analysis. With this, we aren't trying to guess the future target price. We are only asking one question. What is the growth rate that the current stock price implies? And with today's price and a weighted cost of capital of 7%, the answer is 3.6% for all eternity. But over the last decade, ICE could grow the free cash flow by 17.6% every year, and for the next 3 years, the analyst estimation is a yearly growth of 13.4%. So for the near future, we have a growth expectation that is roughly 4 times as high as the growth rate that the current stock price implies. Even with my already conservative short-term growth estimation of 12.4%, there is still a lot of room for error. So we don't even need to believe that ICE goes back to its historical growth rates to make the math work. We just need to believe that it doesn't permanently plateau at 3.6%. But before you hit the buy button, we need to have one last look at the balance sheet, because there is one very specific reason for the discount. As I showed you earlier, in 2023, ICE bought Black Knight for $11.9 billion, and this pushed the goodwill on the balance sheet to $13.6 billion today. But it also pushed the debt levels up, with their net debt to EBITDA sitting at 2.5 times. The company is already paying down the debt, but that massive goodwill introduces an impairment risk. It only works if Encompass retains its clients, unlocks synergies with other segments, and mortgage volumes recover. If any of those assumptions break, the amount of goodwill needs to be written down. And when ICE acquired Black Knight, one condition was that ICE was forced to divest Empower and Optimal Blue to Constellation Software. The original vision was a fully integrated mortgage stack. Origination, pricing, servicing, data. All inside ICE. But that bundle is now incomplete. It doesn't break the thesis, but it weakens it a little bit. Instead of a total monopoly, ICE now has to actively support and cooperate with Constellation Software. So, what's the final verdict? We have a triple layer moat, 19 years of double-digit compounding, and a reverse discounted cash flow implying 3.6% perpetual growth for a business that has delivered 17.6% historically. The mortgage dip is cyclical, but the goodwill risk is real. And the discount to its peers is 20 to 30% with no structural justification. What you are buying here is not a speculative growth story. It's an exceptional financial utility operator with high margins. For me, that is a clear buy. And that is exactly what I did. I just bought 20 shares of ICE and I'm planning to add more in the next couple of weeks. Now, if you enjoyed this video and want to see more wide moat companies, hit subscribe. This is just the first episode of my Wide Moat series, and I'm planning to do this frequently from now on. But as always, that's just my opinion. Now, do you agree on my thoughts on the mortgage market and ICE, or do you think that the goodwill risk is just too large? Let me know down in the comments. And if you want to know why the SpaceX IPO is very bad news for other space stocks, watch this video next. And of course, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.